the hedge fund that almost crashed the world. In August 1998, a single hedge fund came within a hair's breadth of toppling the global financial system. The firm was Long-Term Capital Management, better known by its initials, LTCM. It wasn't a massive bank or a sovereign fund. It was a boutique partnership started in 1994 by two Nobel-winning economists, Myron Scholes and Robert Merton, and a handful of Wall Street veterans, including former Salomon Brothers traders John Meriwether and Victor Agani. LTCM's strategy was simple in theory, but brutally precise in execution. Use massive leverage to exploit tiny pricing inefficiencies between related securities government bonds, interest rate swaps, and equity index futures. The managers believed that because the price differentials were so small, they could lock in risk-free profits while the market corrected. To magnify those returns, they borrowed roughly 25 times the firm's equity capital, taking on $125 billion in exposure, with just $4.8 billion of their own money. For 3 years, that gamble paid off spectacularly. The fund posted annual returns exceeding 40%, and its reputation grew into a myth. LTCM could sell a bridge in New York and buy it back in Tokyo for a profit. That aura attracted more capital, and the leverage grew. By early 1998, the partnership held positions in over a dozen markets, from U.S. Treasury bonds to Russian government debt. Then the Asian financial crisis hit, followed quickly by Russia's default on August 17, 1988. The market moves that LTCM had counted on tiny, predictable spreads suddenly widened dramatically. Losses piled up faster than the fund could meet margin calls. In just weeks, LTCM's equity fell from $4.8 billion to less than $200 million, while its leverage positions threatened to ripple through banks, brokers, and pension funds worldwide. Recognizing that a disorderly collapse could freeze credit markets, the Federal Reserve convened a private consortium of the firm's biggest creditors: Goldman Sachs, Merrill Lynch, Morgan Stanley, and others. The banks agreed to inject $3.6 billion and take over LTCM's positions, effectively a bailout that kept the fire from spreading. In the end, the fund was liquidated, but the episode showed how a $1 trillion notional exposure, backed by a handful of investors, could have destabilized the entire financial system. LTCM's downfall taught a lasting lesson. Leverage magnifies both profit and risk, and when a strategy depends on small arbitrage, any market shock can turn a modest bet into a systemic threat. The episode didn't involve a single trader's gut feeling. It was the product of sophisticated models, massive borrowing, and the assumption that history would repeat itself unchanged. Understanding LTCM isn't about personal finance tips. It's about recognizing the structural risks that can arise when a few actors hold outsized, highly leveraged positions. The 1998 crisis reminds us that the health of global markets often hinges on the discipline of a single, highly concentrated fund.